Imagine someone hands you a list of the 5 stocks that will perform best over the next year and the 5 that will perform worst.
Right.
You think this is like an absolute license to print money. But here's what actually happens. Even those future winners, the stocks that will end the year up 200 or 300%, they regularly crash 20 or 30% along the way.
Oh, absolutely.
And if you have any kind of leverage and any kind of risk limit, those crashes force you out of the trade before the payoff even arrives. So today's deep dive is looking at a study that quantifies that exact problem precisely.
Yeah, and it really is a fascinating tool to research. I mean, what we are looking at today is a study that explores this massive, often brutal gap between having perfect information.
Knowing the destination, basically.
Exactly, knowing the destination. The gap between that and the actual reality of implementation, which is the journey. Because it turns out, knowing the future just isn't enough if you can't actually survive the turbulence required to get there.
Right. And whether you are like an active day trader watching charts all day, or you're just someone with a standard retirement account checking in once a quarter, this deep dive is going to fundamentally change how you think about good financial information.
It really redefines what risk actually means.
Totally. Because having the ultimate cheat code to the stock market, it still doesn't guarantee you win the game.
Not even close. I mean, you can literally have tomorrow's newspaper today and still end up bankrupt.
Okay, so let's unpack this. We need to start with a baseline opportunity here because the theoretical numbers in this study are just absurd.
Those are staggering.
Right. So the scenario is you take this perfect list of stocks and you create a portfolio. You go along the top 5 best performing stocks of the year and you short the bottom 5 worst performing stocks.
Right, the absolute extremes.
Yeah. And the researchers specify that this is an equal weight dollar neutral portfolio, which, just to pause there for our listeners, dollar neutral just means like for every dollar you bet on a winner, you bet $1 against a loser, right?
Yeah, that's a perfect translation.
So if the whole market crashes or skyrockets, you don't get wiped out by the macro trend.
Right. You are completely insulated from whether the broader stock market has a good year or a bad year. You're purely betting on the fact that your 5 winners will beat your 5 losers.
Got it. So you run this dollar neutral strategy with perfect foresight, and the strategy earns a staggering 276.5% annualized return.
Yeah.
And the study notes it has a Sharpe ratio of 4.49. Now, I know in the real financial world, a Sharpe ratio over 1 or 1.5 is considered incredible. But for our listeners who, don't spend their days staring at Bloomberg terminals, what does a 4.49 actually mean?
Well, the Sharpe ratio is essentially the holy grail metric for investors, right? Because it measures how much return you get for the risk you are taking.
The risk-adjusted returns.
Exactly. So a ratio of 1 is fantastic. A ratio of 2 is like the stuff of Wall Street legends.
Wow.
So a 4.49 is basically financial science fiction. I mean, it represents the theoretical absolute ceiling of stock picking ability. If you have no constraints whatsoever, no margin calls, no risk limits, just infinite patience, you are looking at a gross edge of almost 1,200% compound annual growth rate over the long run.
That's just wild.
It is an enormous, spectacular opportunity.
Which naturally leads to my first big question. If I have a treasure map that is 100% accurate and my gross edge is 1,200%, why am I not a billionaire by Tuesday?
Right. And that is because of a concept the researchers map out that they call the waterfall.
The waterfall.
Yeah, the data shows this massive chart in Figure 4, a literal waterfall, where that gross edge of nearly 1,200% compound annual growth just erodes, step by step by step, as you introduce real-world implementation constraints.
Okay.
You start at the top of the waterfall with your perfect foresight, and by the time you hit the bottom, the water has all but dried up.
Okay, so let me try to figure out where that water is going. Because if it isn't the stock picks themselves, my mind immediately goes to the mechanics of trading. Like, Wall Street always gets its cut, right? If I'm rebalancing this perfectly optimized portfolio all the time, the transaction costs and fees must just bleed the strategy dry.
See, that is a very common assumption, and it makes intuitive sense. But the study completely refutes it.
Really?
Yeah, trading costs barely make a dent in this scenario. The researchers applied a realistic 25 basis point one-way trading cost to every transaction.
Which is what, just 0.25% per trade?
Correct. And do you know what happened to that 1,197% gross return when they applied that fee?
Let me guess, it got cut in half.
It dropped to 1,184%.
Wait, that's it?
That's it.
Wow. Okay, so losing 13 percentage points when you're making over 1,000% is basically a rounding error.
Exactly. The trading cost myth is totally busted here.
So if fees aren't killing our time-traveling investor, my next guess is just the sheer psychological terror of managing it.
Well, psychological terror is definitely a byproduct of the experience, for sure. But mathematically, the true destroyer of this strategy is the drawdown stop-out.
Okay, the stop out.
Right. In the real world, no one has unlimited capital, and absolutely no professional trades without risk limits.
Of course.
So a stop-out rule just means that if your portfolio falls by a certain percentage from its peak value, you sell everything, you cut your losses, and you move to cash.
You just stop the bleeding.
Yes. So when the researchers imposed a simple 10% drawdown limit, meaning if the portfolio dips 10% from its high water mark, you are forced out of the trade.
Okay, what happens to the return?
That massive return plummets. And it doesn't drop to 1,000% or even 500%, it drops to 16%.
16%.
16%.
Wait, from nearly 1,200% to 16%.
Yeah.
That is an absolute bloodbath.
It really is.
But, I mean, it does make sense on the surface. Why does a basic, prudent risk management rule like a 10% stop out completely destroy a theoretically perfect strategy?
To understand that, we have to look at the day-to-day journey of a perfect stock. You see, the return is calculated at the end of a 252-day trading year. But you don't get to just skip to the end. You have to live through every single one of those 252 days.
And this brings us to a concept they outline in the data called pathology.
Yes, figure 9.
Honestly, this was the absolute wow moment for me when I was reading through our sources. Pathology essentially means that even the absolute best perfect winners crash violently before they eventually win.
Exactly. And the underlying data on this is shocking. Remember, we are talking about the top 5 best performing stocks in the entire U.S. market for any given year.
Right, the absolute gold medalists.
Yet, in nearly 40% of the yearly vintages studied, those eventual top 5 winners dropped more than 20% at some point during the year before they recovered.
That's crazy.
And in about 13% of the years, they dropped more than 30%.
Here's where it gets really interesting for me. It's kind of like boarding a flight that, will land safely in Hawaii.
Right.
But it has to plummet 10,000 feet in freefall halfway there. You might have the absolute right destination, but the turbulence is so violent that it forces you to parachute out of the plane over the ocean.
Right.
Like you hit your 10% drawdown limit, your broker automatically liquidates your position, and you are just left sitting in a life raft watching the plane pull up and land safely on the beach without you.
I love that analogy because it captures the true helplessness of the situation. And remember that turbulence is just the long side of the portfolio.
Then do you want to go up?
Right, the stocks you bought hoping they would go up. The short side, where you are betting against the future worst performing stocks, is actually far more treacherous.
Yeah, figure 10 maps that out. It highlights an absolute nightmare scenario on the short side.
It really does. Future losers frequently rally dramatically before they finally collapse.
Right.
Imagine a stock that is destined to lose 80% of its value by December. In March, it might suddenly rally 40 or 50% on a false rumor, a change in management, or just a random market frenzy.
Yeah, just market noise.
Exactly. And if you are shorting that stock, a 50% rally is devastating. It squeezes your position exactly when your leverage is highest.
The case studies in Figure 11 really bring this to life, especially when they looked at the year 2000, the bursting of the tech bubble.
A classic example.
Let's try to paint a picture of what that actually felt like. Imagine it's January 2000. A company like Pets.com or Webvan is going to be virtually worthless by the end of the year.
Right. The fundamentals are garbage.
So logically, you short them heavily. But before those .com stocks went to zero, some of them rallied 300, 400, even 500% in the interim months.
Which means if you were a portfolio manager in the year 2000, you had clients screaming at you, your broker was demanding more margin, and you were bleeding cash every single day.
Wow.
The terminal returns, like the end-of-year destinations, are entirely positive for the strategy. But the interim drawdowns are completely devastating.
You literally go bankrupt knowing you were right.
Exactly. What's fascinating here is the asymmetry of the entire mechanism, and it all comes down to mark-to-market accounting.
Just to pause there, the researchers use that term mark-to-market accounting a lot. Can we translate that for everyone listening?
Of course, mark-to-market just means your broker doesn't care about what you know will happen in December.
Right.
They look at the price of the stock today. They require you to maintain capital based on today's prices.
Ah, yeah.
So as the investor, you bear all of the interim downside risk. You suffer the turbulence, you hit your risk limit, you get stopped out, and your portfolio is forced into cash.
And then you miss the rebound.
Exactly. Because you are now sitting in cash, you completely miss the guaranteed terminal recovery. You suffer all of the pain, but you are barred from the payoff.
Man. So if the turbulence is mathematically guaranteed to be this bad, how slow do you have to drive this theoretically perfect car to keep it on the road?
Well, that brings us to another great concept from the study, sustainable volatility.
Sustainable volatility.
Yeah, in Figure 7. Sustainable volatility is defined as the maximum amount of risk or the maximum amount of leverage you can apply to this strategy without breaching your drawdown limit.
So as you said, it's the speed limit.
Right.
And what is the speed limit for our time traveler here?
If you enforce that standard 10% drawdown limit, the median vintage over the 60-year history of the study can only sustain 25% annualized volatility.
Wait, let me make sure I'm hearing this correctly. 25%.
25%.
But, like, the long-run volatility of the normal, boring S&P 500 index is comparable to that, and sometimes even higher.
It is.
Are you saying an investor with perfect, flawless stock picks actually has to trade more conservatively than someone just buying a regular broad market index fund?
Yes. That is exactly what the data shows.
That's insane.
It sounds entirely counterintuitive, I know, but it makes mathematical sense when you look at the mechanics.
Okay, break that down for me.
When you hold an index fund, you hold 500 different stocks. They balance each other out. Some go up, some go down, and the overall ride is relatively smooth.
Yeah.
But this perfect foresight strategy is intensely concentrated. You are holding only 10 stocks, and not just any 10 stocks. You are holding the absolute extreme outliers of the entire market.
The wildest wild horses.
Precisely. The 5 biggest winners and the 5 biggest losers of the year are, by definition, the most erratic, volatile companies in the market.
Makes sense.
Their individual daily paths are so violent that if you apply almost any leverage at all to them, you are mathematically guaranteed to hit that 10% drawdown wall. You just cannot leverage extreme outliers without getting shaken out.
That actually makes a lot of sense when you visualize how crazy those specific stocks act. And the researchers proved this with a really clever robustness check, right? They tweaked the strategy to see what would happen if you diversified.
They did. They expanded the portfolio. Instead of just picking the top 5 and bottom 5 stocks, they ran the simulation picking the top 20 and bottom 20.
Which, if you think about it logically, means you are actively including worse stock picks.
Right.
You're diluting the perfection of your signal by including the 20th best stock instead of just the number 1 best.
You are diluting the signal, yes. But the Sharpe ratio, that holy grail metric of risk-adjusted return we talked about, it actually increases.
Ah.
It jumps from 4.49 for the 5-stock portfolio up to 6.55 for the 20-stock portfolio.
That is wild. Adding worse picks makes the strategy perform better.
It does, and it completely reinforces the core thesis of the study. By adding more stocks, you are diluting the intense, idiosyncratic path risk of those individual crazy stocks.
The ride just gets smoother.
Exactly, the ride becomes smoother, which means you can sustain slightly more leverage without getting stopped out. The reduction in daily turbulence is mathematically worth more than the absolute purity of the perfect stock picks.
Okay, so we know the speed limit is shockingly low. The time traveler essentially has to drive 25 miles an hour in a school zone. But human nature is what it is. What happens if an investor gets arrogant, ignores the speed limit, says, I know the future, I can't lose, and tries to use aggressive leverage anyway?
Then they fall off what the study calls the volatility cliff.
Right. Figure 16. If you map this out conceptually on a graph, the drop-off is so violent it literally looks like a cliff.
It does.
It's like this flat plateau of returns that just plummets straight down into nothingness the moment you add too much leverage.
This is genuinely the most surprising finding of the entire study for me. Let's say you decide to target 100% volatility. You lever up aggressively because, again, you have a list of guaranteed winners.
You want to maximize it.
Right. But if you target 100% volatility with a 10% drawdown limit, the strategy literally makes no money.
I actually had to read that line in the research 3 times. You have a cheat code to the universe, you maximize it, and you end up poorer than if you just left your money in a high-yield savings account.
Oh, it gets worse.
Wait, the return goes below 0.
Less than 0. The compound annual growth rate becomes negative 0.3%.
How is that even mechanically possible? I mean, you know the exact stocks that will go up 300%. You leverage your portfolio to maximize the gains, and you end the year losing money.
It's because of the stop out and how leverage multiplies the pathology. At 100% target volatility, your portfolio is swinging so wildly that you hit your 10% drawdown limit almost immediately.
Ah, I see.
It's like putting a Formula One engine in a shopping cart. The engine is perfect and incredibly powerful, but the chassis is so unstable that the moment you hit the gas, it flips over and destroys itself.
That makes perfect sense. If a stock drops 5% in a day, which is, totally normal for a volatile tech stock,
Sure.
but you were levered 2-to-1, your portfolio just dropped 10%, boom, you're stopped out.
Exactly. You get liquidated on like day 12 of the year. The data shows that at that aggressive leverage level, the strategy spends 100% of its time sitting in cash. You get stopped out instantly, your money goes into a cash account, and you spend the next 240 trading days watching from the sidelines as the stocks do exactly what you predicted they would do.
Ouch.
If we connect this to the bigger picture, leverage doesn't just reduce your edge.
Yeah.
Past a certain threshold, it mathematically destroys it. It transforms a perfect informational advantage into a guaranteed loss.
Man. Well, we've painted a pretty grim picture of perfect foresight here.
We have.
But, to be intellectually honest, we need to look at the boundaries of this simulation.
Yeah.
No academic model is perfect, and we need to step out of the pristine laboratory for a second.
Fair enough.
So I want to push back on a few things. First, the model uses a daily equal weight rebalancing strategy.
Right.
That means every single day it is buying and selling slightly to keep all the positions at exactly the same weight. Doesn't that actually make the problem worse?
It's a great point. A daily equal weight strategy basically forces you to catch falling knives. If one of your perfect winners crashes 30% in a week, the equal weight rule forces you to sell your stable stocks and buy more of the crashing stock to maintain the balance.
Which just drains your capital.
Exactly. A buy and hold strategy, or maybe a dynamic strategy that adjusts based on momentum, might actually survive the turbulence better because it wouldn't be continuously forcing capital back into a plunging asset.
Okay, what about market impact? The study applies a flat trading fee, but if I try to drop, say, $1 billion into a tiny microcap stock, the price is going to move aggressively against me.
Absolutely.
The simulation doesn't seem to account for the sheer physical difficulty of moving massive amounts of money into these volatile stocks.
You are absolutely right. The cost model is linear, which is a big simplification. Real market impact scales with size. For a massive hedge fund, executing these trades without destroying their own edge would be incredibly difficult.
Especially on the short side. I mean, in the real world, borrowing a terrible stock to short it isn't free. Does the model account for the fact that a garbage company is incredibly expensive or sometimes impossible to borrow?
That is probably the biggest blind spot in the simulation, honestly. The study largely ignores margin requirements and the real-world mechanics of short selling.
Yeah.
To short a stock, you have to find someone willing to lend it to you. And if everyone knows a company is destined to crash, the borrow fees can be astronomical. The study just sort of assumes you can magically short them for free.
Right. And finally, the 10% drawdown limit. It feels a bit arbitrary. A massive institutional fund might have a strict 5% limit, while a retail trader trading on their phone might stomach a 30 or 40% limit.
The limit is arbitrary, yes. The researchers acknowledge that. But, and this is crucial, while the exact numbers change depending on the limit you choose, the qualitative lesson applies to any limit.
The cliff is always there.
Exactly. Whether your stop out is 5% or 30%, the path risk eventually triggers it if you apply enough leverage. The cliff always exists. It just moves slightly to the left or the right.
So, what does this all mean for you, the listener? Let's bring this out of the academic realm and into reality. If having literal, magical, perfect foresight of the future is this difficult to monetize,
Yeah.
the gap between knowing what to buy and surviving the trade long enough to actually make money is just massive.
It is the exact difference between being a stock analyst and being a portfolio manager.
Oh, that's a great way to put it.
The analyst just has to be right about the company. The portfolio manager has to be right about the company and survive the path, manage the leverage, and endure the drawdowns.
It's incredibly humbling. So to summarize what we've covered today, the gross opportunity of knowing the future is unthinkably huge. We're talking 1,000% returns.
Right.
But because of pathology, the fact that winners crash and losers rally, coupled with standard risk management tools like stop-outs, the amount of leverage you can actually use is tiny. It forces you to take incredibly modest risks, even with a guaranteed outcome.
And this raises an important question, right? It's something I think every investor needs to reflect on. We spend all our time, all our energy trying to find better information, better signals, the next big stock pick.
Right. Everyone wants the alpha.
Everyone wants the alpha. But what if the true definition of risk in the markets has nothing to do with the accuracy of your information and absolutely everything to do with your capacity to endure being temporarily wrong?
Your capacity to endure being temporarily wrong. I really love that. And honestly, it doesn't just apply to the stock market. Think about your own life or your career.
Oh, for sure.
Like, if you know a career shift will make you infinitely